Silicon Valley Bank is now shut down by regulators in the biggest bank failure since the global financial crisis. And this could affect us Tesla stock investors, so I'll cover everything that we Tesla stock investors need to know about this. And even though you probably never heard of that bank, it is actually a huge bank. It is the 18th largest bank in the United States of America. And I keep seeing many people saying, oh, this is not a big deal. The financial industry is now much more regulated since the 2008 crisis. There's no way there's going to be a chain reaction. Everything is fine. You don't worry about it. Well, I am worried. And I was working this morning to move my money from small institutions into institutions that I think would be much safer, because check this out. The nation's 33 biggest banks have enough capital to withstand a severe economic contraction, the Federal Reserve said Thursday. This was last summer. Now, I have a question. Did we just experience what they call a severe economic contraction? No, we have not. So how come we have this huge financial institution fail? The 18th largest bank in all of the United States. I hope this is just an isolated case and there's not going to be a chain reaction. Is that what is actually going to happen? I don't know. It's probably not very likely, but I am definitely not betting my money on that. I mean, Lehman Brothers CEO Richard said to employees that the company was strong and stable just a few days before it filed for bankruptcy. So let's see exactly what is happening. She is a chartered financial analyst and a former money manager. What does this mean for Tesla stock? And will the contagion spread across the financial system? Wednesday, Silvergate announced it's ceasing operations. Yesterday, Silicon Valley Bank stock crashed 60%, and now it has been closed. The bank attempted to raise capital, which I talked about yesterday in a video. Then they tried to sell to a larger bank and couldn't. And many banks are facing the same problem. Their bond portfolios were locked in at low rates. As depositors withdraw money, banks may have to sell their bonds at huge losses to come up with the money. If too many customers withdraw at once, which is exactly what just happened, the bank's losses could be massive. Silicon Valley Bank's problem started with a $1.8 billion loss on the sale of its available-for-sale bond portfolio. Rumors swirled that the bank was facing huge interest rate risks on its $91 billion portfolio. It appears that the bank had liabilities equal to $195 billion. And if your assets go down significantly, then that is a problem. It only had $212 billion in assets. This is as of September 30th. But if your assets go down by about 10 or 15 or 20%, your whole bank is in trouble. And the problem was they had a huge influx of cash in 2021, and they wanted to put that money to use. And what they did, they purchased mortgage-backed securities. But 97% of these mortgage-backed securities were 10-year duration securities. And the yield was only 1.56%. That's super low. And because the interest rates are now higher, these mortgage-backed securities, if you sell them today, are going to be worth less money because you want the same yield that you can get from other places, so you will pay a lot less for these mortgage-backed securities now. And here's where the big problem is. Many banks are facing the same problem. Their bond portfolios were locked in at low rates. Withdrawals feed the vicious cycle of selling bonds at a loss to cover the outgoing deposits. But the most important question right here is, how liquid are those assets, those mortgage-backed securities? And can they be liquidated without causing massive losses? And turns out the answer to the last question was absolutely no. And this is where it gets really bad. Other banks are potentially facing similar problems. First Republic Bank, for example, the stock is down as much as 50%. And the drop was rather sudden, down 50% at one point, although luckily it has recovered some, but still down 28.5%. And it has a lot of assets, almost $200 billion in assets. And if things get really bad, you could see a lot of this. Not good. Not good. And here's another interesting fact. Only 2.7% of Silicon Valley Bank deposits are less than $250,000, meaning 97.3% aren't FDIC insured. And you may look at this and say, oh, that means it's not really a big deal because it's just companies, right? Startups putting their money into this bank. It's just corporations, not individuals. No big deal. What is all this fuss about? Well, a lot of these startups have employees, and if they just lose most of their cash, can they still operate? That's a question to think about. These people, of course, are going to lose their jobs, the people that were working for this bank. But how many more people will also lose their jobs? Because these companies that had the money in this bank will also have to perhaps shut down or how to lay off some people. Interestingly, SVB's website, Silicon Valley Bank website, said that they have relationships with more than 50% of all venture-backed companies in the US. It doesn't mean that all of these people keep all of their money in this one single bank, but maybe some do. Interest rate risk is an inherent challenge of running a bank. However, a contagion could still be playing out. The potential failure of one bank can lead to many others failing just because of fear. And there are multiple bank stocks that have been halted. There's a list right here. If I had money in any of them, well, I would probably be moving it and taking it out. Many are also comparing this to the 2008 collapse of Lehman Brothers and Bear Stearns. One thing to keep in mind is that those institutions were investment banks, and we are talking about commercial banks that take in deposits. While a commercial bank can certainly get into trouble, they can't have anywhere near the 31x leverage that Lehman had when it collapsed. But commercial banks can certainly fail. Selling bonds at losses and realizing losses on bad loans are two big problems banks are having right now. So if the economy gets worse, these banks could be in more trouble. But Silvergate and Silicon Valley Bank did business with FTX, plus many other formerly overvalued tech companies that are now crashing back to earth. Are big banks like Wells Fargo and JP Morgan in danger? Michael Barr, the Fed's vice chair for supervision, spoke on that yesterday. The exposure tends to be a very small part of their balance sheet, he said. So even if they experience the same deposit outflows, they are more insulated. This, of course, though, is not very reassuring because the nation's biggest banks supposedly had enough to withstand a severe economic contraction. This was published in June, and it actually included 33 biggest banks, including, I think, Silicon Valley Bank. And it failed, and there was no severe economic contraction. So if we actually do have a severe economic contraction, what is going to happen then is the question. And what does this mean for Tesla stock specifically? Well, Tesla stock today is actually doing pretty good so far. If you compare that to the rest of the market, you can see that the market feels some strong pain. And this is why I like holding Tesla stock, because Tesla stock is somewhat largely insulated in my deep belief. It does not mean that the stock cannot go down. No, it certainly can. I just believe that the business that Tesla has is largely insulated from a bad economic crisis. And actually, there is a case to be made that this could even be really good for Tesla's stock, specifically short term, because if this is indeed an isolated incident, maybe the Fed would stop raising the rates this fast. And if that happens, guess what is going to happen to growth stocks? Growth stocks like low interest rates. But if this turns out to be the beginning of a chain reaction, then everything is probably going to be affected. But we'll see. Hopefully, it's just an isolated incident. But I am prepared for the absolute worst. And looking at JP Morgan report, they have $48 billion almost in unrealized losses. That is about 3 times as much as the Silicon Valley Bank, although JP Morgan does have a lot more assets. So this is not that big of a problem, but I'm just saying it's not a unique problem to just Silicon Valley Bank. But certainly it appears that a big bank like JP Morgan would be in a much better position to handle a potential bank run. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.